In this video, we provide more detail about the statement of cash flows. Let's return to the financial statements of Harbor Island Company and focus on its statement of cash flows, which explains how Harbor Island's $100 cash balance at the beginning of the year became a $220 cash balance at the end of the year. During the year, the company collected a net amount of $11,420 in cash from its operating activities, spending a net amount of $3,600 in cash on investing activities, and spending a net amount of $7,700 in cash on financing activities, leading to an increase in its cash balance of $120, the difference between the $100 beginning cash balance and the $220 ending cash balance. Notice that we emphasize that for each activity, the dollar amounts are net, which means that the cash inflows associated with the activities have been reduced by the cash outflows associated with the activities. A positive number, as in the case of Harbor Island's operating activities, means that cash inflows exceeded the cash outflows, while a negative number, as in the case of Harbor Island's investing and financing activities, means that the cash outflows exceed the inflows. Here's Harbor Island's complete statement of cash flows for the entire calendar year 2000XX, including additional detail about the company's operating activities, investing activities, and financing activities. Operating activities refer to the transactions conducted by a company directly related to the acquisition and sale of its products and services. These transactions tend to be usual and frequent. Cash receipts from services is the actual cash collected from clients for the services provided by Harbor Island. Cash receipts from sales is the actual cash collected from customers for the product or inventory sales made by Harbor Island. These two cash inflows are related to the activities in the accounts receivable and unearned revenue accounts on the balance sheet. Cash inflows from prior sales come from accounts receivable, and cash inflows received in advance create unearned revenues. Cash receipts from interest is the actual cash collected from the debt investments held by Harbor Island, which you can find in the Assets section of Harbor Island's balance sheet. Cash payments to suppliers and employees are the actual cash payments made during the year to suppliers of inventory, as well as payments to the company's employees for wages and salaries. These operating cash outflows have to do with the purchase of inventories, payments to reduce accounts payable, and cash payments to reduce previously accrued wages, all represented by accounts on the balance sheet. Cash payments for other operating expenses refer to actual cash payments for items like advertising, insurance, utilities, and other usual and frequent expenses necessary to generate the company's revenues. The related balance sheet account for these operating cash outflows would be other payables, which would likely include a number of accrued liabilities. Cash payments for interest and taxes represent the actual cash payments made to service the company's contractual debt, as well as the payments to various government taxing agencies. These operating cash outflows would be related to the interest payable account on the balance sheet and a taxes payable account that would likely be included in other payables. This brings us to the amount of cash provided by the company's operating activities during 2000XX, $11,420, which shows that the company's operating activities have successfully produced positive cash flow. This particular way of presenting the operating section of the statement of cash flows is referred to as the direct format of presentation because it discloses the actual cash flows, which can be traced directly back to the cash T account in the ledger. While this form of presentation is easy to follow and understand, it is not widely used in the real world. The much more common method of presenting the operating section of the statement of cash flows is called the indirect form of presentation, which is illustrated here. Note that net cash provided by operating activities, in this case $11,420, is the same number produced by the direct format. However, in this indirect format, it is computed in a different way. It begins with the $10,000 net income number, which, as you recall, is the product of the accrual system of accounting, a system that recognizes revenues when they are earned and expenses when they are incurred, not necessarily when cash is collected. Then it adds or subtracts the adjustments designed to convert the accrual-based net income number to the amount of cash provided by the company's operating activities. It is called indirect because it computes net cash provided by operating activities indirectly. The indirect presentation format is based on the fact that the actual operating cash inflows and outflows reported in the direct presentation format are not the same as the revenues and expenses on Harbor Island's income statement, and it provides a reconciliation between the net income number reported on the income statement, in this case $10,000, and the net cash provided by operating activities reported on the statement of cash flows, in this case $11,420. Let's briefly describe some of these adjustments, starting with the add-back adjustment associated with depreciation and amortization. Recall that the depreciation and amortization expenses are recorded with an entry like the one indicated in the top left-hand corner. This entry creates an expense and reduces net income, but it involves no operating cash outflow. Depreciation and amortization are non-cash expenses. Consequently, to derive cash flows from operating activities, any depreciation or amortization amounts recorded during the year must be added back to net income in the calculation of net cash provided by operating activities. This is true for any non-cash expense. Another example, although not illustrated on this statement, is a realized loss on the sale of a non-inventory asset. As the entry in the upper right-hand corner shows, this loss would reduce net income without reducing any operating cash flows. Accordingly, it would also have to be added back to net income when adjusting net income to equal net cash provided by operating activities. Similarly, but working in an opposite way, a realized gain would have to be subtracted from net income. Such gains, as illustrated in this entry, increase net income, but do not increase operating cash flows. Yes, cash is increased, but this cash collection is not an operating cash inflow. It is an investing cash inflow. Therefore, it would be included in the investing section of the statement of cash flows. Realized gains and losses on the sale of non-inventory assets, like those discussed here, are covered in video 18 of this series entitled Sales of Non-Inventory Assets. There are a number of other items that require similar adjustments, and in all cases, these items involve an entry that created either a revenue or an expense on the income statement, increasing or decreasing net income, but did not involve an operating cash inflow or outflow. That takes us to the next area of adjustments, change in current items. This area involves adjustments where the change in current asset or current liability accounts on the balance sheet explain the difference between net income and net cash provided by operating activities. In two earlier videos, videos 19 and 20, that consider accrual to cash adjustments, we describe and illustrate how changes in these accounts explain differences between accrual-based net income and net cash provided by operating activities. We will not repeat that coverage here. Instead, we will illustrate the idea with a single example. Let's focus, for example, on the $80 subtraction associated with the increase in accounts receivable. Let's see if we can figure out why an $80 increase in accounts receivable balance would cause net income to be $80 higher than net cash provided by operating activities. Consider a case where the accounts receivable balance is $100 at the beginning of the year. Assume that during the year, $350 worth of services were provided for clients on account, giving rise to this entry. And during the year, $270 in cash was collected from clients on outstanding receivables, giving rise to this entry. As you can see, during the year, the accounts receivable balance increased from $100 to $180, an increase of $80. Now let's consider the effects of this activity on the income statement and net income, as well as the effects on the operating section of the statement of cash flows. When we recognize the $350 in revenue, it ended up on the income statement, increasing revenue and net income by $350. The cash collection during the year of $270 from the outstanding receivables increased operating cash inflows on the statement of cash flows, as well as net cash provided by operating activities, NCOA, by $270, which is $80 less than the $350 increase in revenue and net income. This means that subtracting the $80 increase in the accounts receivable balance from $350 of net income will give you the $270 cash receipt reported on the statement of cash flows associated with the activity in the accounts receivable account. This explains why the $80 increase in accounts receivable is subtracted from net income in the computation of net cash provided by operating activities. Simply, revenues were recognized faster than cash was collected by $80. This same approach can be used to explain each of the remaining adjustments, and as mentioned earlier, these adjustments are discussed and illustrated in prior videos 19 and 20, dealing with accrual to cash adjustments. You may wish to review these videos. The indirect format is more difficult to understand than the direct format, but as your accounting knowledge increases, you will increasingly appreciate the usefulness of these adjustments, which reconcile accrual-based net income with net cash provided by operating activities. We now move to investing activities, which refer to transactions management enters into to manage the company's long-term or producing assets. Assets appearing on the balance sheet that are not for sale, but rather are used to support operations. Cash payments and receipts for the purchase and sale of the company's investment securities refers to the actual cash flows associated with the company buying and selling investments in the stocks and bonds that are listed in the asset section of the balance sheet. Cash payments and receipts for the purchase and sale of property, plant, and equipment refers to the actual cash flows associated with the company buying and selling properties, machinery, vehicles, and other similar assets like intangibles, which again are listed in the assets section of the balance sheet. This brings us to net cash used by investing activities, negative $3,600. This negative number indicates that Harbor Island is growing because it shows a net investment in more producing assets held by the company. Presumably, these additional investments will lead to additional future revenues. Evidence of this growth in producing assets can also be seen by noting that the dollar amount of the producing assets listed on the ending balance sheet exceeds the dollar amount of the producing assets listed on the beginning balance sheet. Financing activities refer to transactions entered into by management with the company's capital providers, the debt and equity holders. These transactions affect the company's capital structure, the relative reliance on debt versus equity in financing the company's assets. cash receipts and payments to increase or reduce principal on the company's short and long-term debt refer to actual cash receipts from and payments to the company's debt holders, not including interest, which is listed in the operating section of this statement. It appears that Harbor Island paid off more debt during the year than it borrowed. And note that this debt is listed in the liability section of the balance sheet. The next three categories all describe the cash effects of transactions with the company's shareholders or owners. The company collected $700 by issuing equity, selling stock. It paid a $6,000 dividend to the shareholders, and it paid $600 to buy stock back from the shareholders. All of these transactions are also reflected in the shareholders' equity section of the balance sheet. Issuing equity would increase contributed capital, buying back stock would normally decrease contributed capital, and dividends would reduce earned capital or retained earnings. This brings us to net cash used by financing activities, negative $7,700. Overall, it appears that during the year the company made significant cash payments to its capital providers. A net of $1,800, $2,800 minus the $1,000, was paid to debt holders, and a net of $5,900, $700 less $6,000 less $600, was paid to the equity holders. To summarize Harbor Island's cash activities during the year, the company generated $11,420 from its operating activities, of which a net of $3,600 was used to invest in more producing assets, and a net of $7,700 was used to provide cash to the debt and equity holders, and $120 was used to build its cash balance from $100 to $220.